Cool, Skyler. Just wrapped up with James. Lot of fun. Great call. Cool to get his insights on the market. We talked about AI vaults. Vaults definitely a big thing they're working on. Good call overall. I thought thought James had a lot of interesting perspective things to say.
Yeah, I agree. I think given his his experience over time in the markets in the crypto, both TradFi and crypto, right? Then obviously talking about where things are going, the conversation about vaults and yield, the yield dynamic, and obviously talking about October 2025 to present, what's happened in the markets, where he sees us going. I think it was a very fun and fascinating conversation for sure.
Yeah, get into DATs too. So a lot of good stuff lined up here for you guys.
All the topics are covered.
100%. Awesome. Without further ado, jump to the episode. Thanks for tuning into the All Funds Network podcast. My name is Mike Schroeder. Today I'm here with my co-host Skyler Steinke, and we are joined by James Harris. James is the CEO of Tesseract. It's a MiCA-regulated digital asset yield manager based in Helsinki, Finland. He's built and scaled multiple crypto businesses since 2017, following 15 years in the traditional finance industry. James, thank you so much for joining us today.
Absolute pleasure, Mike. Really happy to be here.
Absolutely.
Awesome.
Let's James, maybe let's kick it off with your background. Tell us tell us a little bit about your background. Curious, kind of what got you into the crypto industry, and we'll kind of take it from there.
Yeah, no, absolutely. So as you mentioned in your kind intro, I spent sort of 15 years in TradFi, and I worked as a trader at many buy and sell firms, sell side firms. And so during my career, I was really quite lucky to trade a lot of different types of instruments. So I started trading equities, and most notably emerging market equities. So no stranger of volatility right from the get-go, trading Asian stocks during crises and stuff like that. That was a lot of fun. But also like futures and derivatives, bonds. So I got a really well-rounded look of financial markets. And I actually first heard of Bitcoin in 2013. And I was working at a bank, and one of my colleagues at the time was telling everyone to get in, and she was really ahead of our time. I was just looking at it as a potential trade. I think it's trading like $200, and I'm like, okay, might be able to make 100% on this or something. But just as I was sort of getting interested in it, there's the arrest of Ross Ulbricht, so then the founder of Silk Road, and now pardoned, of course, which is the right call in my view. And of course, that was all over the FT, Financial Times, sorry, and Bitcoin was implicated in the article. So I just basically laughed it off, and what a big mistake that was. So I missed the boat to get in at 2013. But then in 2016, I was consulting for a deliverable FX company. And it was this experience really that opened my eyes into the kind of role that crypto could play. And I was beginning to take more and more an interest, not as a trade, but as utility. And so the price action, of course, was helpful. So 2016 was a bull market. And, I was basically one of the guys that was pulled in that bull market. But what the FX company showed me was that it was still, and I couldn't believe this, but, 2016, 2017, it was, and it still is in some ways, ridiculously hard to send money cross-border. It's inefficient. It's enabled by rent-seeking banking networks that basically control who can be on it and who can't, right? And so to me then, like permissionless money kind of made a lot of sense. And so clear to me that Bitcoin as permissionless hard money was good. And then Ethereum had just done its ICO at the time as well. And so that made sense to me as a distributed computer to build smart contracts on. And really have programmable money. And I think that was a winning combination. Of course, then you had all the other coins that launched after that. And so I looked at that and I thought, well, again, what is the way that I can help serve this asset class? And the only thing I knew was asset management. So I set up a fund. We were actually the first, or one of the very first UK-regulated funds we got via a partner, but to hold these assets. But it very quickly emerged that as I was pitching this to investors, they said, okay, so how are you going to hold these assets? And sort of said, maybe my ledger isn't the smartest way to do this. And so it was very clear that there were no good ways to keep the assets safe. And, Fireblocks and Copper were just starting out. In fact, I knew the founders that were setting them up. And BitGo had been around since 2013, so 4 years before, but it was still quite US centric, and others were only just emerging. And so as a result, we thought that rather than run a fund to hold the assets, it'd be better to pivot into custody. So we made a deal with a technology company to help us with private key safekeeping, that kind of stuff, and we started to build. And then in 2019, the bear market hit, and it was safer to be acqui-hired by a company, and they just sold their mining division, and they were flush with cash, and they wanted to build lots of different diversified financial services. So it seemed like a good place to be. I didn't end up staying all that long for lots of reasons. I prefer businesses with focus. But after that, I joined a market data company, which I worked at for 4 years, and I helped scale it and build a index business before it was acquired by a company now owned by Bullish, CoinDesk. So that was nice. But then I found that I just wanted to be nearer the assets again. Once a trader, always a trader. And so the opportunity arrived for me to take the CEO job at Tesseract. One, I wanted to prove that I could manage a company again. And two, I just wanted to get closer to the assets and perhaps provide some investment returns on those assets in a business that could help the ecosystem in that way. So that's my background in a nutshell.
I love it. That's great. That's always cool to hear the story of like where you started from the market perspective, who you talked to, your colleagues, what were they doing? Curious if you still keep in touch with your colleague.
We're not in touch. I looked her up, and I expected her to be like CEO of some exchange or something, and I couldn't quite see what she'd been up to, but she was really early and a real evangelist. So credit to her for spotting emerging trends.
Yeah. She's retired on the beach now, I think.
Maybe. Good for her. She deserves it. So.
Yeah. All right. That's cool. I guess speaking kind of current state now, James, being kind of where the markets are at, maybe if you want to give us your thoughts as to currently, what happened in February, the current dynamics of what's going on, current state would be helpful as well.
And maybe even just to take a step back, because we're recording this in February. Maybe let's go back to like October. That's kind of where everything started. The madness.
Yeah, I think it's probably fair to say that there is some connection to what happened in October that might have followed through in February. But really, it's really interesting to say we're talking about two events that happened within sort of 3-4 months of each other that have seismic shock waves across crypto. So the October 10 flash crash was the largest single day liquidation event in history. So we saw $19 billion worth of liquidations. That's more, to give you context, than anything we saw during the Terra Luna debacle of 2022 or the FTX blow up of late 2022. So that was really something, and it happened sort of on a Friday night into Saturday, which is crazy. So we were up pretty much that Friday night and up the whole weekend to make sure that our counterparties were all fine. Fortunately, everything was fine. But then we had this Jan-Feb effect, Feb sell-off, which was a steady sell-off throughout Jan, and then an acceleration into February, and February 5 and February 6. And like I mentioned, the two events might be connected, but they definitely had completely different dynamics. So, the October flash crash had its origins more in crypto, and the February flash crash, as I'll get into, had its origins more in TradFi. So let's go through October. So what happened was markets were near all-time highs. There was a ton of leverage in the system. Many people maxed long, all right, multiple times long, leveraged long. And then Trump came out and said he probably was thinking about adding a few more percentage points of the tariffs on China, right? And that basically spooked the market. And what happened is that the markets moved so quickly that basically I think we fell from something like 124,000 on the day to 104,000 on Coinbase, which is a huge move, 20% move in no time at all. And what happened is that a move like that effectively will take out stops, and then the liquidity falls away because the market makers say, okay, hold on, something big's going on, so I'm going to step away and I'm going to reduce my size on this stuff, which means that then these stops have to liquidate because they're effectively sells that go to market order, but there's no bids, right? So these stops then push prices to find new liquidity, often through other stops, creating a liquidity cascade. So you get these huge widening of spreads across centralized exchanges, and at the same time, because you've got stress in the system, you have gas prices skyrocketing, which means that you need to be able to send your collateral over to different exchanges to make sure that you can support and provide margin for some of your open trades. But if you can't get them there in time, you can be closed. So that was quite catastrophic. And at the meantime, you had these weird kind of peculiarities that were going on. And I won't name any names on the exchanges side, but there was one very large exchange that everyone's heard of, that basically had a stable coin that was linked to some yield generation activities, nothing to do with Tesseract, full disclosure here, that effectively depegged. And the nature, and there's the Athena coin that depegged. And what happened is that on this exchange and on some of the decentralized exchanges, this peg was hard coded onto the system. So even though the thing could depeg, it couldn't depeg on some exchanges, which meant that arbitrageurs could take an asset worth 60 cents and exchange it for other assets where that asset is now worth 100 cents, right? And so that then caused all kinds of haywire and arbitrage opportunities, and ultimately people get wiped out. So order books were already creaking. Market makers were stepping back, going like, "What's going on here?" Insurance funds were completely extinguished, and basically auto deleveraging kicked in, which is the ultimate kick in the face for a winning trader. Because what happens is that your winning positions are closed off to fund losing positions and ineffectively socialized losses. So if you had a hedge on, think of this, right? You're okay, you're hedged, but if they take your winning trade off, in this case, you're short, and you can't get filled on the buy, then effectively your capital can very quickly dwindle, right? So I think then if you look at the price action, you saw many assets go to very near zero. Even things like Sol traded like single-digit numbers, which is crazy. So this would have created some sizable losses for some participants. And we haven't really seen any high-profile victims of this event, which leads us to speculate, and I'm sure you guys agree, is like, okay, so where are the bodies, and are they going to be surfaced at some point, right? And so then you wonder, okay, now February comes. February is interesting, and I was watching these price declines, and for the life of me, I couldn't really see the stress in the crypto markets. I mean, I saw big red candles with lots of volume, but it didn't look like a capitulation low. But it turns out I was sort of looking at the wrong place. The place that I should have been looking was in the BlackRock ETF, Bitcoin ETF market. And there you see all of a sudden, hold on a minute, volumes were 2 times the highest record day. The options complex on IBIT traded 10 times the average volume. And so really that's where the stress was. So what's going on here then? So it's worth sort of just explaining like one dynamic, one trade that TradFi was putting on pretty much with wild abandon, which was they were going along the underlying and then effectively shorting vol, which is a classic TradFi strategy. And it's generally speaking a winning one, but it means you're basically short options. And if then, which means that you're effectively short gamma, right? And gamma is basically sensitive to the rate at which the price falls. And you then therefore have to, if the price starts falling very quickly, you start having to sell the underlying to hedge yourself. And so when that happens, if you think about it, the price starts falling really quickly. You're then forced to sell more of the thing that's falling really quickly, creates a squeeze, and you get what you see on February 5 and February 6. And so this whole thing, right, about the institutions are coming in crypto, well, they're here and look what they've done, right? So careful what you wish for. But I think that that's probably the two dynamics that played out. What might have happened is that in October there were funds and positions that were lost, and then perhaps maybe more capital was allocated to some of the other trades that were happening in the market. So this vol selling trade, and potentially also exposing themselves to things like gold and silver, which were going through the roof at the time, in potentially a way to make back some of the money they lost. And maybe this was then the final death knell in some of these funds. And so there are lots of great accounts all across sort of X and LinkedIn about what may have happened and which funds may have been blown up. But maybe we saw some flushing out of the 10-10 event in February. And for now, it looks like prices have stabilized a little bit. Sentiment is still shell-shocked. It's still scary out there. And it'll take a while for sentiment to return. But hopefully, we're sort of holding last cycle's all-time highs at the moment for Bitcoin. Hopefully, we can build from here. It's not been a lot of fun, though.
Yeah.
100%.
Absolutely.
Do you think, do we hit the bottom here? I think it, bottom around like 60K most recently.
I'd love to hope so. I mean, it's very hard. I maybe talk a little bit about the cycle, but it's very hard to know where we are here. If you look at the classical sort of crypto cycles, the 4-year halving cycle, you're looking at a bear market, right? Now we've gone into a bear market very quickly from October, which is usually the sort of high of the cycle. But that model doesn't really make a ton of sense to me, because ultimately the Bitcoin emissions versus the current supply, even if you halve it, it just doesn't materially impact the market all that much. And so potentially we're looking at a business cycle, but then the business cycle is kind of okay, right? Macro news out of the US in particular is beginning to look very good. You've got a weak dollar. All of the conditions are there actually for a strong performance in Bitcoin, but it hasn't happened. That's what's weird. That's what's concerned me. So I would say, like, okay, yeah, maybe from a cyclical perspective, we should be going into a bear market, but there are some mitigating, factors why we should be doing quite well here. So my map's gone, no idea, but ultimately still very much a believer for Bitcoin in the long run, and these will probably prove to be accumulation levels when you look at them in hindsight and you wonder why you didn't buy more. But as you know, right now it feels pretty scary, right? So that's why you didn't buy more. Just remember that.
Yeah, it makes sense. Yeah, it's I mean, we've all been sitting here too, watching, like you said, the metals go crazy, and wondering why we don't have more gold and
right?
silver in our portfolio.
Yeah, no, I had some in my pension. I felt great, and I sold it out at 4,200, and it felt great. And then, of course, it went another 30% in a few days, so it didn't feel so great. But the gold move kind of makes sense, and gold has done what it's supposed to do: weak dollar environment, potential currency debasement, geopolitical jitters. Right? These are all great gold environment stuff, which is why it's so disappointing that Bitcoin hasn't held up onto its narrative. But one might say that it front ran all of this, right? And we went up to 124K before anything else did. Then there are others that believe that maybe it's just a laggard and it will start picking up anytime soon. The one trade that didn't make any sense to me whatsoever is silver. That just, to me, is a silly trade. Frankly, silver is a quite abundant metal that is also a byproduct of many industrial processes, can easily be created. So that, as a sort of brother to gold, is just speculation at its finest, and I've never really understood that trade. And so not surprising that then you saw crazy volatility, even much more. The irony is much more volatility in silver than you saw in Bitcoin.
Yeah, that's it reminded me, just the run on silver reminded me of just like the altcoins back in maybe like 2021.
GameStop,
that was nuts.
Altcoins, all of those things, right?
Yeah,
all in the same path.
Yeah. So interesting dynamics in the markets. But I think that I guess one other factor that you have to look at is AI. AI is a really interesting dynamic. Like I look at it daily, trying to figure out how we can use it for our firm, how we can improve our processes, the creating AI assistants, these kind of things. We don't have that at Tesseract yet, but I definitely see that trend. Ultimately, I think that this means that any non-physical good or a digital good or service, the price should go to very, very low. I think this is going to be massively deflationary, which probably will accelerate another leg up in growth in the countries and economies that can put it to work. And so it is a complete game changer, and still trying to understand how to use it. But it's incredible how quickly that space moves. You thought crypto moves quickly. The AI world, you're off X for 2 days, and it's like it's 5 steps ahead of where you were, and you're catching up. But very interesting to track.
Yeah, let's actually.
Yeah, definitely.
Go ahead, Skyler. I know AI is right up your alley. Go ahead.
But just interesting, to your point, James, how we see the market going. Obviously, you got one side trying to figure out what to do with it from a utility point of view. The other side trying to make sure we have compute power to power the market, right? And that dynamic shifts on a sometimes hour basis. Who you talk to in the news. So it's pretty interesting to see kind of the things are happening
totally.
in real time.
I mean, one thing's clear though is that the demand for energy, it's only going one way, and Musk's clearly seen it. President Trump's seen it, and of course, like other nations, other nations like China see it. And it's about getting cheap, abundant energy, because ultimately that's the defining use, right, of compute. Compute uses it, and I think that certainly in Europe, we've misunderstood the energy requirements. We've misunderstood. We've misread the tea leaves when it comes to getting sustainable energy, abundant sustainable energy. Like, I very much love that sentiment, but ultimately you do need the electrons, as they say, and you will fall behind an economy that has plentiful electrons. And unfortunately, it's as simple as that.
Yeah, definitely. And when you say going up, it's going way up. I think everyone wants the data centers in space, right, to get the full push.
Well, you don't worry too much about the climate up there, and you maybe get the cooling. So I definitely see the rationale.
Yeah, James, maybe this would be a good spot. Maybe tell us a little bit about what you guys are working on in Tesseract, and we'll kind of dive in there and maybe talk about some of the use cases you guys are seeing with AI too.
Yeah. So I hate to talk about the company. It's not a plug, but let's just talk about a little bit very quickly about what Tesseract does. It's an institutional yield generation platform, and so we deliver yield on digital assets to end users, and they can be institutions, they can be resale, or we deliver them via distribution partners. So one of our key clients is Bitstamp, which was recently acquired by Robinhood last year, and it's wonderful to work with Robinhood, a dynamic American company. And ultimately, so we provide a whole menu of yield options on digital assets to our clients and our distribution partners. You mentioned in the intro, we got our MiCA regulation specifically for DeFi asset management, which is a big deal. That means that we're able to deploy DeFi asset management strategies in a regulated way, and that's a key cornerstone of our strategy going forward. And before that MiCA license, we were a VASP for several years, but ultimately we earn yield in two ways. So the first way is that we lend out our assets at higher rates than it costs us to service them, so we take the spread. And the second way is that we take these assets and we deploy them across the DeFi ecosystem. So that's very much like an asset manager, and this is the MiCA-regulated side of the business. So that's what Tesseract has historically done. Now, what we found last year, and this is an interesting dynamic in the market, is that more and more our clients were saying, look, this sort of centralized TradFi asset management structure doesn't really work for us. We send you your assets. It's a bit of a black box. You send us a monthly statement. You tell us how the assets are doing, and that's it. Kind of got to take your word for it. Whereas in this other side of the market, you've got these vaults. And vaults are basically on-chain asset management structures, which are very interesting. And what they do is they link your wallet from your custodian or your own personal wallet to a on-chain asset management structure. And you effectively can see from your wallet through to the vault to the end market exactly what you're exposed to in real time. So from a transparency perspective, vaults are great. And you can arrange deals with the so-called curators or the asset managers of these vaults to effectively stick within mandates that you pick. So vaults are an incredible innovation, which is also happens to have the benefit of being pretty much non-custodial, which means that if you're running a vault, you don't actually have to have custody of the assets. You just need to have the right to be able to make trades on behalf of those assets. So vaults are really interesting, and I think that if you helicopter out and look at financial markets and you look at the tokenization of financial markets, then to me it's clear that in the long run, people will do asset management in this way, whether that's tokenized Tesla, tokenized treasury bonds, tokenized FX, whatever it is. Like, this can all be done on chain because it's safer and it's a better experience and it's more transparent. So to me, that's the way the whole asset management stack is going. So for us, it's really interesting to look at vaults and potentially land an offering that could be a primitive to the way that the entire asset management stack will be running their processes. Now, the problem that we see, at least in Europe, is that vaults in their current shape have some, let's just say, difficulties with the regulatory framework. So in Europe, you've got the MiCA framework, which is a crypto-specific framework that focuses on the rules and regulations for firms like us that want to provide services in assets like Bitcoin and stablecoins and that kind of thing. And what MiCA says is that you can't commingle assets, you can't pool assets, and if you do, you fall under MiFID, because MiCA is what we call a deferential framework, which means that anything not covered by MiCA should be covered by MiFID, right? And under MiFID, you've got lots of rules for what happens when you commingle funds and how to to handle stuff like that. It's professional investors only, and you have to KYC and AML everyone. And what we notice about vaults in Europe is that they're largely not compliant, and they will argue that they're in the grey area, and that's fine. But for us as a regulated entity, we need to make sure that if we want to offer vaults to our clients, we need to do that in a compliant way. So we're very excited about that, and we're working on a solution at the moment that will allow us to offer vaults in a compliant way, and we think that we'll have some good news to share come April. So very excited about that, and that's where I think, going back to this, one of the reasons why I wanted to join a firm like Tesseract is to be able to be at the bleeding edge of the intersect between crypto and innovation on the fintech side, and that's what we're doing now, and I'm very, very excited about the path that we're treading. As ever, right? Life never makes it easy, and so a 50% correction in BTC and 80% correction in alts means that your revenue is taking a bit of a hit, but this is part of the course. I joke that I've been in crypto 10 years. I'm celebrating that I've been in crypto 10 years. Sometimes it feels like commiseration, but there we are. At least we get to do new things, and there's never a dull moment.
Yeah, no, it's exciting. I think exciting and painful sometimes at the same time, right? As you see the dynamics coming in full speed. It's interesting about the Bolt conversation, as you mentioned. Obviously, regulation from MiCA perspective, and obviously the U.S. is in a similar vein of trying to figure out regulatory clarity. I mean, where do you see? I mean, this obviously has to happen in every jurisdiction dealing with crypto. We've seen it happening, in even the U.S. What's considered a security versus not. New nuances around, DeFi. What does that look like? Where do you see kind of that going?
You make a really strong point about securities and the current vaults. I think if you look at the way that people interact with those vaults, they receive vault tokens, which are effectively proportional representations of their investment in a pool, which effectively looks like a tokenized share of an unlicensed hedge fund. That, to me, no matter how you cut it, is a security, right? And so I think that the US has been very pragmatic since there's been the change in regime, and they've been very pro-crypto, led by President Trump and the crypto czar David Sachs, who we all listen to on Fueling podcasts from time to time. And I think that though, if you look at the European regulation, remember what regulation is supposed to do is to protect the underlying interests of the consumers, right, and to make sure that they don't go into stuff. One could say that's overreach, but ultimately you're trying to protect someone. And Mike has been quite progressive, but ultimately there has to be this thing is like, okay, just because an asset is different or on a different rail, you should still treat it the same way that an existing asset might exist. And so if there are rules in place for equities, and you've got an asset that trades on a tokenized rail, then that surely should be the same way. So the way we see this is that I think if we could land a compliant solution that is that works for the MiCA rulebook for very clear reasons, that should work for other regimes as well, even if it's not been designed explicitly for other regimes. Like at the end of the day, the thing that you're trying to do is still the same. And so I look at that and I think, well, our solution should be consumable by anyone. Now, obviously, if we want to offer solutions in the US and be in the US, we need to be regulated in the US. We're not currently, but as we look to expand, that's something that we might look at. And in the meantime, it's interesting for us to be able to serve customers from all over via distributors that sit in different places. So that's something that we're looking at, and we're always assessing our regulatory footprint to make sure that we're doing the right thing. Because otherwise our regulator would not be happy with us. And the last thing we want is to invite the ire of overseas regulators as well.
Talk to us about the, competitive advantage when it comes to MiCA as more of an opportunity than a burden. How does regulatory clarity kind of, attract institutional capital, if you will?
Yeah. So we do see it. Thanks for repeating our slogan back. We do see MiCA as an opportunity more than a burden, because ultimately there are institutions that have to play by their rules, and their rules are set by their regulators and their compliance departments. And they then see an exciting product like a vault, and they absolutely want to participate, but they can't, because they've worked out the flows and they've come to some conclusions that we have, that basically the existing the existing structures aren't compliant in the strict rule of law, or at least according to that handbook. And so this is where now we celebrate the fact that DeFi has permissionless peer-to-peer interaction at its heart, and there'll always be an ecosystem to serve individuals that care very much about that. But if you're talking about a service that's 10x better than, say, the traditional rails, you need to create a compliant version of that so that the other institutions can also play. And that might mean that you have some parallel systems. That's regrettable in some ways. Like, a lot of the premise that drew me to the space is like equal inclusion, that kind of stuff. Not having these proprietary networks and zealous middlemen that I talked about right at the beginning. But ultimately, if you want to offer a experience, which I believe is 10x better, which the DeFi markets can offer, you do have to create a version of that allows institutions to interact with each other, or other fully doxed, for the want of a better word, fully can't think of the word, fully KYC and AML counterparties that can then operate, can trade with each other on platforms that are frankly better. So I like that, and that's something that we hold very dear to our heart here at Tesseract. So like, let's take the best of the crypto world, offer it to everyone, and remember we can serve end users as well. Although unlike some platforms, we do KYC and AML them all to make sure that we are fulfilling all of our license requirements. So that's the opportunity. And I think that, if you look at vaults, they're big businesses as it is. I think I mentioned they're $20 billion and growing from sort of 200 million at the beginning of last year. So real growth. But that could be even bigger when all the TradFi asset managers come in. First to consume native assets, but then after that to start doing DeFi with tokenized bonds and stocks. And that to me makes a lot of sense, because effectively it's just another network. But the way to then interact with this is really useful. So I think that's us. That's why we think that regulation is a strength for us, and we want to bring institutions into the game in a way that they can be safe and accustomed to dealing with that game.
Yeah, that sounds great. Kind of switching gears just a bit, James, I want to get your take on the digital asset treasury, the data opportunity here in 2026. What does that look like from your view? Why treasuries need to maybe generate yield to justify their existence?
It's been a real roller coaster with that. I remember when Michael Saylor's then MicroStrategy, now it's called Strategy, of course, started coming out, and we were all cheering his initial purchases, and it moved the price, and we were very happy about it. And then increasingly it got a little bit too big to handle, right? So now he's got $48 billion worth of Bitcoin, and his enterprise value is 58 billion. And he's generally speaking a very loud spokesman for Bitcoin, which has been great. He's been a cheerleader. But it's also beginning to store up potentially some of the glimpses of systemic risk that could occur at some point in the future. Now, Strategy probably is going to be fine because they started early and their cost base is quite low. They're considered as the top operator in the space. But some of the other DATs that sort of jumped on the bandwagon of wanting to provide vehicles to hold these assets, they're late, and they don't have the same skill, frankly. Now, bear in mind that the reason initially we have DATs was because there weren't any ETFs. So the way for people to own Bitcoin, say, in a stock form, was to buy MicroStrategy at the time, and that gave you your exposure. Now you had various ETFs that had been trading. They weren't ETFs, but they were like listed trusts. They were trading on pink sheet markets. The grayscale stuff, which had a lot of people in, but it didn't. It's different to a stock, right? A stock that trades on an exchange that everyone's heard of. And so that was the core reason that I think they started, and how now Strategy was able to build a bit of a moat around it. Now, the problem that current DATs face, at least on the Bitcoin side, is that they now have these quite formidable competitors called ETFs, right? And if you're running a DAT and your cost base is up, let's say 2%, so that might be the case for one of the smaller DATs. Maybe Strategy's cost base is lower because it's so big. But if you're a small DAT with $100 million, then it's easy to think that you've got a cost base of 2%, sometimes even 5%. That means that you need to do a better job than your cost base. So that means that with your treasury, you somehow need to outperform the Bitcoin price by 5%, which is really hard to do without taking a lot of risk. Now, some of the other DATs have it easier. So if you look at the Ethereum DATs, they can take advantage of native staking, which is, of course, one of the other ways that one can earn yield, and is often called the risk-free rate of return for that particular protocol. So an ETH DAT could, in theory, take the assets it's got, stake what it might not need in terms of liquidity requirements, because it can't stake at all, because in case it do something with the treasury or whatever, but maybe it stakes 70% or something like that, then it could justifiably perhaps cover its cost base and maybe even outperform an ETF. But the Bitcoin guys have got a bit of a problem, because Bitcoin doesn't have native yield unless they're a big mining operation. And as we know, mining is, it's an extremely compute intensive business that many miners actually can't make any money out of, which is why many of them have moved to AI, ironically enough. And so the Bitcoin guys need to do something different, and they need to either put their assets to work and do some option strategy over the top of it, like some of the stuff that we talked about, how that might have exacerbated the February crash. Or they might need to do some lending, or they might need to find ways to wrap their Bitcoin and have it transact across the DeFi ecosystem. Now, those are things that Tesseract can help that's with, and then we see that as a big opportunity for both the DATs and ourselves to help with it. The problem that they have is that they have to outperform the ETF, because otherwise there's no reason for that for them to continue. But embedded in their perhaps zealousness or excitement to get to the market, they actually wrote themselves pretty tough mandates, which meant that it's very hard for them to actually lend out assets. So they might have to vary their mandates to say, look, listen, I know we said we'd keep it in Fort Knox, these Bitcoin keys, but we might have to not keep them in Fort Knox and try and earn some return, because otherwise kind of buggered, right? And so we're going to see some of that, I think. So that's my prediction for this year. Some of the DATs are going to say, hey, we've relaxed our treasury requirements. We can now do this stuff, and we can target 2 to 3% yield on Bitcoin, which is a good level of return relative to what's out there in the market. Like if you try and wrap Bitcoin on, say, Aave, you might get 30 basis points per year. So if you can get 2-3% return, that might not compensate you entirely for all the risks you're taking, but it will cover your cost base. And I think that that's an interesting angle. And we'll see more of that if these DATs want to remain relevant.
Yeah, it's a good point.
Yeah, that's
So
really
I guess a
interesting.
lot of these,
Right
a lot of
Yeah.
these DATs are financed. They might be taking out debt to purchase these assets. So really, at the end of the day, you have to not only pay off that, but you have maybe a management team. Obviously these guys have salaries and whatnot. So really kind of covering that cost basis is kind of the name of the game. Yeah.
Yeah, totally. Like I say, otherwise, I'd rather put my money in ETF and pay a 20 basis point fee, if that, right? And if some of these ETFs, like 21 shares, who just got bought by Calconex, I believe, we can start offering ETF plus type returns, then it's going to be really hard for so now it doesn't cost me money to hold an ETF, but I earn return as well, like maybe an ETH performance product or something like that. Then it's really hard for that, and they just need to they need to invest the time to figure out how to run their treasury better, and that should be their story to their investors as well. It's like, hey, this is going to be our treasury strategy. It's not just enough anymore to have access to cheap financing. I need to be able to earn returns as well.
It's a great point. I mean, thinking about it more, these are almost going to become kind of hedge funds.
I think so, but they're not staffed by hedge fund people. That's the problem, right? And so you bring in some people that might have a couple of years of experience in Bitcoin and maybe a couple of years of like hedge fund strategies. That's not enough. Like that doesn't cut it. You need to have people who know the market, understand how this can move. Like, otherwise you get caught in moves that we've seen in the last few months, frankly. And it's not an easy game. You're constantly dodging landmines. So that's something you need to bear in mind. And the correct experience is correct. It's important to have the correct experience.
Yeah, got to do a little bit better job of timing the market, and then kind of just hope the assets increase in value.
Yeah, exactly. Bitcoin needs to remember that it can go up as well as down, and I think that's unfortunately where we're at. But look, it always feels sort of darkest and scariest near the lows. I put out a piece earlier this week where I said, look, I've never seen sentiment this low. I think the crypto greed and fear index fell to 5 out of 100 at the low there. and that is several points below where it was in the absolute depths of FTX. And I lived through FTX, and to me, that December, I genuinely thought that as a narrative, it was over. And unfortunately, we caught a bit of a rally that January of 2023, where we rallied 30% out of nowhere, which I think sort of saved us, because at that point, it was just like, well, this is just a joke. Everyone was laughing at me. You had people saying like, what are all these Bitcoin bulls and crypto bulls talking about? It was not nice, their victory laps and everything. It was not particularly fun. This sentiment is lower than that, right? And
it's crazy.
It's just crazy.
It's funny. Yeah. I mean, for those of us that have been in the market for a while, it's going back to 2022. I remember, I think at the time Grayscale was probably still, the trust was trading at probably 20-30% discount to market. So, at the lows, you're buying a Bitcoin at 15 grand, with a 20 to 30% discount. I didn't add to my position. This recent dump, I'm adding a lot.
Yeah.
I mean, for what it's worth, right or wrong.
Yeah. I mean, look, we're exposed with our jobs and our livelihoods, and probably what's the phrase? Irresponsibly long on the PA positions. And so one has plenty of exposure. Right, and I think that's one where sometimes you can add a bit more, and sometimes you're just like, okay, I'm just gonna wait for this to come back up again. And then look, the long-term thesis, I think Bitcoin is intact. If you again go back to AI, one sees an agentic future. What are they gonna pay themselves in? Probably crypto rail type stuff. Like whether that's Bitcoin or not, I don't know, but stable coins make sense to me. That kind of thing. So the bull case for crypto rails is there. Now, whether we need 200 layer 2s and 1,000 layer 1s, that's another question. Like probably not, right? I think that, we probably should pick some winners and build on the winners rather than having a huge array of things that do effectively the same thing. So, Bitcoin's clearly won the digital asset monetary good category. It would be good if we settled on 4 or 5 smart contract layer 1s, so ETH, Sol, a couple of others, that's it, and let's just build on that, right? Like we don't need another 500 different iterations of that. And I think that's been the problem. We've had this massive dilution of all of these options of things that do the same thing with their own set of influences and people that are excited. So with that, the lack of concentration, when capital goes in, it's sort of like pushing toothpaste. It doesn't go anywhere. Whereas back in the 2016 bull run, or even the 2020 bull run, you had a finite number of vehicles to express that view. And of course, I think that's why you saw much bigger moves. But look, that's not my job to reason why. Like our job is to earn interest on assets that have been adopted, like Bitcoin, like ETH, like Solana, like Ripple, those kind of names, and that's what we do for our clients.
Yeah, well, I think you weathered the tide pretty well, James. I don't see any gray hair poking out.
Very kind filters, perhaps. But I feel every year.
I hear you. Speaking of kind of like maybe the yield conversation, and by the way, I think the connection point between AI and the payment activity and stablecoin environment is a kind of fascinating topic as well. But getting into the yield, I mean, where do we sit from the yield industry perspective? I mean, how do you think about it maturing over time? What does an institutional yield grade product look like in your view?
Well, let's talk about the backdrop for yield, and then talk about what an institutional grade version of that looks like. So the backdrop for yield, again, I thought it was all set up really nicely for crypto, because we've seen the top of the US interest rate cycle, right? And that means that if you get treasuries coming down from say 5% to 3%, then all of a sudden there's a ton of capital that frees itself up from there to flow into crypto, perhaps, that could still show 5 to 7 to 8%. And that's still the case, by the way, for US dollar denominated stablecoins. One can get, without taking too much risk, between 5 and 8% yield on your stablecoins. And customers get exactly that. And one can take a bit more risk and get sort of 10%, 12%. Beyond that, gets a little bit crazy, but that's achievable. So I would have thought, okay, great. So with capital coming out of sort of treasuries and bonds, it will go into crypto to try and earn a higher yield. That hasn't happened. And that hasn't happened because in crypto, like yields have come down as well, which is absurd because yield in crypto is a function of something different. Yield in crypto is a function of market activity, i.e., the more volume that trades in markets, the more prices move, the more opportunities you have to make trading decisions and to earn revenues from that perspective. You might be doing an ARB strategy, right? And buying low, selling high, and doing that lots of times during the day. And they might be high frequency and stuff like that. But if the market isn't really doing that, then and you don't have these opportunities, then you probably don't need to have that ton of money that you've borrowed to do that. And so what happens is that you return the capital saying, like, look, the opportunities are here at the moment, which means that effectively people that still need to lend out their assets have to drop their rates to find levels at which people still want to borrow, because there's always a price, right? And so that's your problem. So at the very moment that on the TradFi side rates come down, like crypto totally fumbles and doesn't have rates to stand up in contrast against it. So that's, and I tell you that because ultimately understanding what the yield landscape looks like is basically how you then deliver an institutional yield grade solution. Because you need to offer dependable yield that is resilient. You need to, if you're lending out assets, that means that your yield source is a function of credit and counterparty risk, which means that you need to do a very good job of vetting the counterparties that you're lending to. And so that means extensive due diligence. That means constant monitoring. I told you that I was up all night on 1010 to speak to every single one of our borrowers to check that they are okay. Nothing beats looking people in the eyes at times like that, and they were all okay. So that was good. But ultimately, that's what it takes to run a book like that. And you've already got an ecosystem of partners that are very, very good at what they do. So we lend to the very top tier of market makers and funds, and then you sort of manage that basket very, very closely. So that's an element of top tier yield generation platform, is managing your counterparties, and then also, I think experience matters an awful lot. Like our current lending program began in 2023, and we haven't had any losses since then. But back in 2022, just like everybody else in the industry, we were definitely exposed, and we learned lessons from that. It was way before my time, of course, but one has to understand that these markets can do crazy things. Like people were talking about 6 Sigma moves in some assets the other week, right? That's not supposed to happen for like 200 years, and yet here they are happening every 6 months. And so you have to have robust processes in place. So that's robust processes, an institutional process about generating the yield itself. Then you also need to make sure that you're delivering it in a safe and secure way. So whether people can access yield via an API that's secure, that means that you have to have all of the technology bells and whistles. So, your SOC, your ISO accreditations. You need to make sure that you're working with the best custodians that also have those accreditations, and then you need to make sure that your systems are robust, because effectively you just have so many more attack vectors than say a TradFi firm does, which can basically say, okay, actually I've lost an asset, but here's some more because of put a line through that and all good again. Can't do that with an assets that's walked out the door in crypto. So you have to be a lot better, and that is really, really hard work. That's the real challenge, and it's especially a challenge in volatile markets, but also markets where your asset base is declining, right, and your revenues are under pressure, and you need to make sure that you've got the team to do it, because you can't compromise on providing those services. So it's a lot to manage, but it's something that we keep doing our absolute best on, and we keep learning from the market and try to stay humble more than anything. Like, this is not an easy game, and you'll never, hopefully, under my watch, hear us bragging about how we're doing. We are just trying to deliver dependable returns to our users, and we try and roll with the punches that the market gives us.
So, Lily, do you foresee any potential like black swans or major risks to the market right now?
Thing about a black swan is that you don't see it coming, right? But sources of black swan. I mean, we've talked about DATs. Maybe some of the later adopting DATs. That's kind of, maybe some of that's played out. I don't know. Obviously, the strategy complex is there. I'm maybe I'm incentivized to. I don't own any strategy, but I'm incentivized to root for Saylor because I think that it would be quite catastrophic him having to reduce his exposure. But from everything I read about strategy, they look to have plenty of years worth of interest repayments in the bank, and so I don't see any short-term concerns there. But look, Bitcoin at 16,000 for 3 years, that will be bad. And I've learned one thing in the markets, and that's not to discount anything. And so I think that's something. But one has to look at it in the Bayesian way. You deal in probabilities, and you say, okay, what's the probability that Bitcoin would do that? Maybe very, very, very low. It's not zero, but it's very low. And maybe you say, okay, what is the Cathie Wood outcome of Bitcoin at $1 million in 10 years' time? What does that look like? And then you try and find a pathway in between that. But all you can do, I think, and all I try and do for Tesseract is try and find a reason to be useful to customers, given what they're asking for. And I think if you do that, then you always stand a chance. Hence our desire to look at compliant vaults, because our customers are asking for that.
Yeah, well said. Ending here on a positive note, James, what are you most excited about in the market right now?
Yeah, like I say, I'm really excited to be back on the sort of vanguard. I think that I'm excited about yield in general. And we talked about the tokenization of assets and creating on-chain asset management services. I think that means that almost anything can have a yield. And that's great because, people buy assets for all kinds of reasons. People buy Tesla because they like Elon Musk or because they like the story or something like that. But wouldn't it be great to have Tesla and early yield on top of that? So I am actually really excited about yield. And personally speaking, I'm very interested and excited to continue learning as a leader. It's in this space, like it's humbling and it teaches you lessons pretty much every day. And just surviving in this market to earn the right to continue is an achievement. I'm very excited about that, and so hoping that there'll be lots of lessons that we can continue to learn from, but also at some point things can also start moving in the right direction for us as an industry. And so I like that, and I'm also excited about the way that the market is maturing. It does take all types of participants. The days of just having a Bitcoin price with no futures, that's all long gone. So now it's about adapting to the new paradigm. Like, what does it mean for institutions to be in the space? Like, how does that distort and change the market structure? How to adapt and that kind of thing. Because, just like with AI, there's always going to be opportunities. And the question is knowing where to look and knowing what an opportunity looks like and then taking it. And that's sometimes hard, as you guys know as well.
Absolutely. Well said, for sure.
Absolutely. Well, James, this has been a lot of fun. Really, really appreciate your insights and telling us about Tesseract, the market in general. Where could people go to connect with you guys and learn more about your offerings?
Yeah. So first of all, thank you very much for having me. I really enjoyed the conversation. And people can catch us on our website, Tesseract.fi, which sounds like financy and glitzy, but it's actually .Finland, but it kind of works both ways, which is cool. So Tesseract.fi. We provide a lot of content on our LinkedIn page. So find us Tesseract on LinkedIn. And we've just got a new sort of marketing drive to start going on X. So we've literally just kickstarting that. Couple of users at the moment, but it'd be great if everyone would get behind that, and we're going to start pushing out content on X as well, because we know that a lot of our industry lives there. And that's where you can find us.
Amazing. Well, this has been a fun conversation, James. We'll make sure to include all your contact info in the show notes as well.